This is lesson 5 of the Seido Trading Learn to Trade series. Up to this point, you've learnt how to identify candlestick behavior, recognize momentum, understand trends, and you've started building out your own structured trading strategy. This lesson is about consolidation patterns. You will learn how to identify flags, inside bars, and trading ranges, and understand why they work and how to trade them. Every candlestick chart has two axes, a price scale and a time scale. The rate of change of price over time is important. In lesson 2, we described 3 different ways momentum can appear. It can appear as a single large candle, which represents a large change in price over a short period of time, or the change in price can occur more slowly. This is also why we covered moving averages in lesson 3. They clearly show how price consolidates by pulling back to the moving average, either by falling into it or by waiting for the moving average to catch up to price. After momentum appears, price consolidates in one of 2 ways, through price or through time. Price-based consolidation is a pullback or a retracement. Time-based consolidation is sideways price movement. Momentum-based consolidation patterns include what traders call pullbacks, flags, triangles, inside bars, dojis, and trading ranges. In the context of momentum-based consolidation, they should all be grouped together. Every type of consolidation pattern is a trading range. Any consolidation pattern is an opportunity for traders to enter with trend. The reason consolidation patterns are so powerful in response to recent momentum is how traders are responding. It's the trapped traders dynamic and the psychology of 3 groups of market participants. So let's break those down. Traders who bought here recognize the momentum in the market and are looking to add to their positions when price pulls back. Traders who aren't in a position, who have missed the move, are trapped out. They've seen the recent momentum and they want to get in. They're looking to buy at a better price than the recent momentum afforded them. They're looking for any pullback for a chance to enter. The final group of traders are traders who are in a losing position. These are traders who are trapped in the wrong direction. They're looking for any chance to exit for a smaller loss. When the consolidation pattern holds the EMA again, traders who are still waiting are forced to respond. Here is the core principle of this lesson. Every consolidation pattern is a trading range. The shape does not matter. Whether it is a flag, a triangle, an inside bar, or a period of sideways movement, a tight trading range, for example, they're all the same thing. Price is moving between a high and a low, and it is doing so while the 3 groups of traders are making decisions. This matters because it simplifies how you respond to them. Rather than treating each pattern as a separate setup with its own set of rules, you're always asking the same question: where is the high and where is the low of the range? So in this example here, we've got a period of sustained momentum and a pullback to the EMA. As we've discussed, the pullback sets up a trading range, the high and the low. In this example here, we've got momentum away from the EMA. We've then got an inside bar. This sets up this trading range here. In the future, when price traded back, you can clearly see traders are selling the high of the trading range. In a bearish context, after momentum to the downside, traders are looking to sell toward the high of the range. In a bullish context, after momentum to the upside, traders are looking to buy toward the low of the consolidation range. Consolidation patterns are broken when price moves with momentum out of them. This allows us to start to develop our understanding of how trends evolve and where appropriate places to put our stops become. A consolidation pattern that doesn't break out with clear momentum like this is likely evolving or has evolved into a larger trading range. So in this example here of the Nikkei mini futures on a 5-minute chart, we have a bear trend. Every period of momentum is followed by a period of consolidation or pullback. I've marked these trading ranges with the high and the low. So as we work our way down, we can see that there's momentum breaking out of the trading range. Momentum out, trading range develops as the pullback. Momentum out and a trading range develops. Notice the momentum out of the low of the trading range isn't strong this time. We get an inside bar and 2 consecutive trading range candles followed by a third one. It's the clue that this may be evolving into a trading range. Traders who recognized that this was a weak breakout, saw the pullback, were then responding by buying the low of the trading range. This is why treating consolidation as trading ranges matters so much. Traders need to assess the recent momentum and decide, are they adhering to the buy low, sell high rule of trading ranges? Or are they chasing price with confidence riding on the recent momentum? One important note on retests. After a breakout, price will often come back to the level it broke out from. This is normal behavior. It is not a failure of the setup. A trader who sold a breakout at the low of a range and then moved their stop to break even has now moved their stop exactly to the level price is likely to retest. Institutions take these orders, and it leaves beginners thinking the market is against them, but in reality, they moved their stop inappropriately. The higher time frame perspective is one of the most important reasons to group all of these patterns together. A flag pattern on a 5-minute chart, like shown here, may be an inside bar on a 15-minute chart, as it was here. A flag consolidation on a 15-minute chart may be an inside bar on a daily chart. The pattern changes depending on where you are looking. The principle does not. Every consolidation is still a trading range. The 3 groups of traders are still present. The high and the low still define the pullback. The scale is the only thing that changes. As we mentioned previously, price transitions through market cycles. Understanding the evolution of momentum over time is just as important as being able to see momentum in the first place. Momentum does not continue indefinitely. A trading range will evolve. So knowing where you are in the cycle determines how you respond to the pattern in front of you. A consolidation late in an extended trend carries different weight than a consolidation early in the move. 2 consecutive inside bars is a very common pattern that can appear anywhere in a trend. If it appears late after a long directional run, it often represents the final consolidation. It's a trap for traders. Price may attempt to break in the direction of the trend, but the move is too extended to hold. Traders who recognize this were putting sell orders above this consolidation, expecting the breakout to fail. Understanding where you are in the cycle lets you respond appropriately around these pullbacks. It is also crucial for your understanding where traders place their stops and why certain levels attract the reactions they do. Your coursework for this lesson is to add consolidation patterns to your chart annotation checklist. Start by identifying whether your market is trending or in a trading range. Then find periods of momentum and look at what price did afterwards. For each consolidation you identify, mark the high and low of the range. Ask yourself where the 3 groups of traders are positioned. Once you have annotated on your lower time frame, switch to a higher time frame. You can do this in TradingView. See where the consolidation sits in the bigger picture and how it appears at scale. What type of pattern existed on the higher time frame chart. As always, course notes and quizzes are available on Seido Trading website. That is lesson 5. You now understand that every consolidation is a trading range, why consolidation patterns work, how traders use the range structure to trade, and how the same pattern appears across timeframes. In the coming lessons, we will cover higher timeframes and how they shape your read of price. I'll see you there.